I think you're right. It's not as binary as kind of let's pedal to the metal, but they are at least looking to take opportunities where we're seeing retail investors, it is very much, as you say, let's use cash maybe for the first time in quite a long time as an asset class that we actually want to see a real yield on. But also we do an investor confidence survey among our clients. There is still a lot of reticence about the market. Every time we start to see some green shoots, then we get another bit of inflation data through, particularly for the UK retail market. And, people are nervous.
I'm just going to wade in with some ECB comments here. This is from Schnabel in an interview with TIJD this morning, saying the impact of our tighter monetary policy on inflation is expected to peak in 2024. So talking about the lag effect here of policy and obviously some action that the ECB has conducted and whether there's more. Saying in this interview there is great uncertainty over the strength and the speed of this process. And that is a problem, isn't it, as we take a look at what the intentions are for central banks and what that does for one of the areas of the market that's been very strong, namely technology. By numbers now, almost 28% of the S&P 500. If we're still going higher on rates, particularly stateside, whether the ECB also tries to keep pace with the Fed, what does that mean for tech stocks that have rebounded so rapidly this year?
Yeah, I mean, just to pick up on that, isn't it interesting that the ECB is saying that when actually, if you look at their inflation, it's one of the ones that's actually being positively impacted by their central bank policy. So if even they are nervous, that really says something. I mean, it's not good news for tech stocks, is it? Tech stocks do well when we have a growth environment where we have money coming into markets. And if we're going into recession, and indeed if things like cash and fixed income seem more attractive asset classes because of that higher yield, it does temper the ability for tech stocks to continue to rally.
Should we be concerned about the weighting of tech names on the broader index, or is that just the reality? I mean, we had an interview about how technology is effectively taking over the future. Is that just reality, that we've got more and more technology now embedded in our economies, and it's only natural that the weighting of a major index would change because of that?
I think there's two ways to answer that question. The first is, are they true tech stocks? Now, Amazon, do you consider that a tech stock or do you consider that a retail stock? It's so embedded now. E-commerce just is the way that we all shop. Or are we talking about those smaller startups, the types of tech companies, for example, that we saw really affected by SVB blowing up?
Well, okay, I've got them. Apple. So we think that's a tech stock, or do we debate whether that's a consumer stock?
Is it even a consumer staple now? I mean, how many people within this room have an Apple product?
Microsoft?
Ditto. I mean, I do think there's that sort of thing of how do you allocate, how do you assign a sector to some of these companies? Some of these bigger companies now they are the incumbents, actually. They're the sort of old dinosaurs that they were once disrupting.
Nvidia, Facebook?
I think there's slight differences with there, particularly around Facebook and regulation. So I do think some of that is less to do with, is it high growth and is it affected by recessionary fears? And actually, is it in a sector where I think regulation is going to become a key driver of whether we can continue to see returns?
Emma, Japan is, again, another one of those next issues as well. Enormous rally. You think there's some mileage left?
I mean, it's had a really good run. I mean, one of the things I saw earlier this week, they were talking about what will really continue to fuel the rally is if retail money comes back into the stock market. They've got $7 trillion in savings accounts in Japan. And one of the governors was saying that higher inflation will draw people back into the stock market because rates are still so low there. Well, word of caution, because we haven't seen that in the retail market in the UK. Higher inflation has actually led people to go, as we've been talking about, into cash. The difference there, though, is they still have negative interest rates. So actually, the real return that you're getting, well, you're not getting a real return on cash. So therefore, as inflation comes up, only 3.5% at the moment, so still low compared to the rest of the world. But, if you've got negative rates on cash and 3.5% inflation, you may well start to look to the stock market.
I'm going to do naughty. They've told me to move on. I just want to ask you, because you've got a view on ESG at the moment. Busted flush?
I think this could be the beginning of the end of the hype party. We've seen in the last month, for example, flows out of ESG funds for only the second time in the last 5 years.
Out of ESG,
yeah,
wow.
Particularly with retail investors. Now, the institutional play is different because it's backed by so much regulation, the Inflation Act, net zero. But for retail investors, actually, the cost of living crisis, there is a short-term cost to gains with ESG. Longer term, you will get that gain. But short-term, people are making decisions now.
Yeah.
It's just that they don't believe that the corporates mean what they say. I mean, the S part here, you get higher inflation, then the companies expand out their margins and try and push back against paying workers more. I mean, what happened to that S part in the ESG if you really care about those around you in the community.
Absolutely, it is much more difficult to make decisions about the long term when short term costs.